Very, very warm welcome to everyone this morning to the second episode of Offshore Off Script. You'll notice this morning, slightly different to number one, is that this is a pre-recorded session and we wanted to make the most use of your time. We know everyone's very, very busy and your schedules are quite tight. However, we are very excited to then reconnect you after the pre-recording to then have a live Q&A session. And this is your chance then to engage directly and ask the questions that you have and you want to ask post the session. If I could ask you in that regard to please post your questions on the chat in the group, in the recording, and then we'll get to those at the end of the session, and we'll even take some live questions if you are brave enough to unmute your mic. So without further ado, let's get to Offshore Off Script Session 2. A very, very, very warm welcome to everyone online to this, the second episode of Offshore Off Script, the podcast where we cut to the chase, we talk straight talk, no fluff, very much around the facts. And today we are grappling with an incredibly exciting topic, and that is offshore global private credit. And we are extremely excited to get into this with you today. To steer us and help us with this wonderful concept, we have two incredibly intelligent individuals with us today. We have a colleague of mine, Greg Goller. Greg, welcome today.
Thank you, Paul.
Greg is the head of structuring and lending at Fedgroup now and the strategist behind the enhanced global private credit portfolio. And excitingly, all the way from Paris, we have none other than Jean-Baptiste Magnin, the managing partner of Chetwode, dialing in, as I said, from Europe. And Jean-Baptiste is on the ground there and partnering with Fedgroup on this incredible portfolio. So welcome, Jean-Baptiste.
Hi, everybody. Thank you.
Right, let's get into the detail. Greg and Jean-Baptiste, thanks for your time again today. And it's wonderful that you can actually share your knowledge on a podcast like this. So it's maybe a lesser known fact, but private credit is the fastest growing asset class globally at this point in time now. At Fedgroup, obviously, we've had many, many years of deep assets sector and private credit specialization in the local markets. And again, now this is a wonderful opportunity for us to now bring the specialized capability from a global perspective and partner with the right people. But really, the first big question I wanted to ask you was, what is private credit? What it is and why? Why private credit, and what actually is? What are we talking about when we talk about private credit?
Yes, thanks, Paul. So as you quite correctly say, Fedgroup has actually been involved in private credit for over 35 years, admittedly in the property space. And because it's property finance, sometimes people forget that it is actually private credit. Private credit simply means that it is non-banked credit, so non-banking financial credit, and unlisted from an investment category point of view. The reason that private credit has become so topical over probably the last 5 years is since the global financial crisis, after which regulation for the banking system became more and more onerous. There was a requirement for a slightly less regulated sector to come and meet the growing credit demands of particularly the small to medium-sized business requirements, both locally and offshore. And for a couple of reasons, because of the importance of owner-managed businesses within the European context, it is much, much more important and much larger in Europe than it is in South Africa. So our journey down the private credit route is nothing new to Fedgroup. Our journey into the international space was important because from an investor point of view, it is very important to diversify your portfolios into hard currencies, into different geographical regions, and the universe of opportunities in the international space, particularly in Europe, is just so much bigger than in South Africa. So we were very fortunate to meet our partners, Chetwode, Jean-Baptiste representing Chetwode, who have had many decades, and apologies, JB, I'm giving away your age, but many decades of experience in the European context, and particularly in asset-backed finance and sale and leaseback. And I think it would be fair to hand over to JB to give a bit more context about how important private credit is in the European context, and how Chetwode grew out of a very strong banking experience of the team into where it is at the moment.
Absolutely. Thanks, Greg. And Jean-Baptiste, before I hand over to you there, just to sort of resonate some of the points you made there, Greg. So first of all, a massively important funding mechanism for your SME market now.
Absolutely.
You know, a gap that's missed. I mean, you're talking about a 3 trillion euro AUM market at the moment now globally.
Yes.
And what is very interesting that strikes me is, and when we get to Jean-Baptiste from a European and on the ground in European context now, you know, it's a commonly known or lesser known fact that in South Africa we have around about 75% of our GDP generated through self-employed or SME market now.
Quite right.
The stark contrast is that is even higher in Europe, up to 95%, if not higher, of the market, you know, is SMEs, and therefore your typical bank funding or your bank credit line cannot realistically cope with that now, and that's why this is such a and also
all of the
not something particularly new, growing at the moment now, but
Yes.
this is not new. This has been tried and tested.
Quite right.
Amazing. Jean-Baptiste,
Thanks, Paul. Thanks, Greg, for handing over the conversation to me. The private debt market has been in existence in Europe for a long time, as you mentioned. But there are two important dates, the first one being the financial crisis in 2008, 2009. After that date, the banks in Europe retreated massively from financing the SMEs and the economy, because they were framed into the Basel II ratios, which prevented them from lending too much, if I may say so. They started by retreating from the long-term credits like project finance, and then progressively, they also retreated from the medium term, let's say 3 to 7 year financing market. So we had an avenue here, and also a few years later, in 2012, the regulation for the investment of the life insurance companies in Europe changed, and they were then allowed to invest directly into the economy, meaning they could lend money to SMEs or to funds lending to SMEs. And this is when we started creating our first ever European leasing fund in 2013. And then since then, we've been developing funds and financing the SMEs in Europe.
Fantastic.
So the point with the private credit from an investor point of view is that in your investment asset classes, the private credit was really as a percentage of your global listed markets, so your global equity listed markets, was insubstantial. It was less than 1%, but we've actually seen it grow over the last 10 years up to 5% of global equity markets, which is, if you put into context the time that it's taken to grow, it means that the growth in private credit has been notable, has been very, very notable in the market. Not surprisingly, it's a very stable type of return in volatile markets. There are methods, especially in the sector that we operate in, which is asset-backed finance, of creating a downside protection. The private credit market does give us a premium rate to your listed credit market for liquidity premiums, but it works very, very well in the context of a long-term investment plan, or if one would call it in this context, a global estate plan.
Yeah, and I think from what I've experienced as well, Greg, that increase in the proportion of one's portfolio that's been exposed to private credits has got to the few factors, as you've said. The return profile suits the risk mitigation and risk profile of portfolio, and that's, I think, the the legacy and the duration that now has been encountered through private credit now has proven it to give those nice, stable, predictable rates of return. But I think a big one as well has got to do with accessibility. We'll talk a bit about it just now as to what Fedgroup is doing to make these type of markets and asset classes more accessible. But I think generally the accessibility has been enhanced, and it's been easier for individuals to access the right portfolios and at lower, more sort of palatable levels.
It's a very good point you make, actually. But if you think of the history of Fedgroup was instrumental in the participation bond market, which effectively gave retail investors access to much bigger real estate investments that were never really accessible prior to the participation bond market.
What is amazing to realize as well through our partnership with yourself at Chetwode is that there's still a significant shortage of funding for high quality SMEs in Europe now, just because of the role they play in the European market. So that really is a massive market that is just looking for that patient capital where returns have been proven out. So we acknowledge the fact that is this sort of the capacity to absorb these capital flows and these investments from the private capital and private credit markets is not sort of, it has no cap, but there's a huge amount of journey still to go to actually sort of totally quench the need for that capital in the SME market in Europe.
Yes, this is very true, and this shortage calls for new funds to enter the European market, and this is what we are achieving at present with Fedgroup. Indeed, it is very important to note that there is an offer in the market for deals below 1 million euro. There is an offer in the market from the large banks for deals above 20 or 30 million euros. But for deals in between, there is a shortage, a significant shortage. And even if, as I said, new funds are getting on the market, arriving from the private equity world, which is diversifying in the private debt investment, there is still a big need for funds or for investors able to finance deals between, say, 1 and 20 million, which is exactly where we are positioning the partnership with Fedgroup for European SMEs.
Jean-Baptiste, that's such a fantastic positioning, and I want to get into a little bit of the deep detail with you and Greg. So ultimately, we see the edge at the moment now for people on the line to sort of be party of this and to be sort of to get themselves involved in this key asset class, and sort of it's very much around the edge. What is the edge that we're trying to bring? And the edge is very much that sort of Fedgroup deep assets knowledge and specialization, accompanied with Chetwode's structuring expertise specifically in the jurisdiction which you are focused, the on the ground stuff that you are involved in. But I'd like you to unpack a bit of the color. And I think that's going to give our audience that much more context around the type of transaction you're talking about. I mean, we talk about private credit. It's not in the listed space now. It's got that sort of in the middle sort of funding size. But give us a little bit of color around some of the nature of the transactions that ultimately sit behind as security and what I like to say the transaction is the engine that generates the return for the investor. I'd love to know more about that.
JB, if I may start, because it's been a very interesting journey, and as you say, the philosophy is very similar to the asset-backed philosophy that we have broadly in Fedgroup. But our mantra, our global mantra, is critical assets in critical supply chains in critical industries. And when I first started with Jean-Baptiste and team, we used a simple example of an olive oil making machine that is owned by a multi-generational Italian family. That's the primary asset that makes the revenue for the family-owned business. And without that primary asset, there wouldn't be a business. And the concept that Jean-Baptiste and team have a huge amount of experience in is creating working capital off the primary assets. And so whether that is by a lease or a finance lease or an installment finance or even a sale and leaseback, we're able to create working capital around that primary asset. The more recent example, which I think is even more critical, if you think about the underlying use of the asset, is a machinery that is used to make what I call wear parts or manufacturing parts that goes into the nuclear power stations. And you couldn't get a better example in France of a critical asset in a critical supply chain in a critical industry. And this is most certainly the mantra with which we follow in terms of our investment philosophy.
As I hear you and Greg chat about these specific transactions, what I love about private credit is your proximity to the transaction. These are real transactions that we can understand. We consume olive oil,
Yes.
on our salads and whatever it might be. Coffee is certainly my daily, as I say, a cup of personality in the morning. When it comes to nuclear parts there, energy generation, could there be a bigger topic in the world now? It's just that absolute where the rubber hits the road stuff, which is really the element of it. And obviously everything backed by physical assets gives that added level of security around the fact that there's tangible security that sits behind it. But and again, I'd love to know you to share more examples, but I think an important one for our audience on the podcast today is we're talking about the words, they've come up there, Jean-Baptiste, financing and credit. What is the nature of the agreement that sits behind it now? Because, we're not talking about equity. We're not talking about private equity. We're talking about a fundamentally different type of financing activity now that sits behind this now. And by virtue of that, the actual risk status of these transactions, and also then talk a bit about, if you could, share a bit about the robustness of these type of partners. So it's that mechanism that we use to actually contract on the transactions. And then also, once again, if you are loaning money to someone in a transaction, a lot of it's got to do with the creditworthiness of that individual or institution now. Love to know a bit about the methodology around that.
Yeah, thank you, Paul. It's a very interesting space dealing with Europe, because I've been involved in investment banking and credit in South Africa for many years. But what has struck me, certainly in our partnership with Chetwode, is the quality of the company that we've been dealing with. Has surprised me, but I think it is because of that niche, the size that we're operating in, that 2 to 20 that JB mentioned. Is a niche, is an opportunity for us, and as a result of that, it's allowed us to participate, number one, but also to participate at very, very good yields. And the concept of credit risk is really broken down into two parts. It's your probability of default, which speaks to the company. And as I mentioned, the quality of the companies that we've been dealing with are extraordinary. In terms of credit rating, the level of credit rating is better than most listed companies, including financial institutions, than we have access to in South Africa, let alone lend to. And then, of course, loss given default. And loss given default is, if anything were to go wrong, what can we recover to be able to cover the exposure? And that speaks to the underlying assets. Underlying assets, in many cases, are very good quality. We tend to keep to non-specialized equipment and non-specialized assets, so that if we needed to redeploy them or to resell them, there is always a market. And we generally keep our what we call loan to value. So we keep the value of the assets way beyond the size of the loan. So our loan to value we keep below 70% in most cases, so that the recoverability is mitigated. The risk of recoverability is so in many cases. The actual credit risk behind the transactions that we look at, as opposed to unsecured lending, is good, is very, very good. And that again is very similar to the philosophy of both Fedgroup and Chetwode, is that asset-backed finance is in our DNA.
Yeah, and I suppose by nature of that, and Jean-Baptiste beautifully summed that up around this magic little the type of the size of the transactions is this wonderful sort of almost underserved, neglected, where the opportunity sits there, is that there's an element of picking and choosing. You can, to an extent, cherry pick the right transactions, so you don't have to do them all and take on undue risk. So to bring it down to layman, so bring it down to my level, Greg, the fact that behind the transaction is actually a loan with a fixed rate, a fixed repayment profile. So it's predictable.
It is predictable, yes, yeah.
And that's an important one for an investor. There's the element of the predictability of the return. This is not something that's going to give big swings and roundabouts. It's a predictable rate of return, very much a forward-looking, and again, the nice thing about that is the one thing that could affect that rate of return is potential default of the counterparty. But in that case, the team at Chetwode and Fedgroup have gone through all those levels of risk mitigation to ensure that doesn't happen. Is that a fair comment in the sense of the nature of the transactions that sit behind the asset class?
It is correct indeed. We analyze two main elements when a transaction comes to our desk. The first element is the corporate that we have in front of us, and as Greg explained, we pick and choose the best corporates that we meet, and then we analyze the assets, the portfolio of assets, to make sure that we will get a security in case there is a problem, which is not what we expect, but in case there is a problem with the corporate. Yeah,
absolutely. Now, I wanted to just ask you the question. And it's, I suppose, easy for you sitting in Paris to answer the question, but it's something that we find incredibly important. To do this by remote control from South Africa is hard, if not near impossible. What do you, I mean, just help me explain to the viewers the importance of being on the ground in the jurisdiction where the transactions are actually taking place. I mean, why is that important?
Oh, it is very important because you visit the companies, you visit the sites, production sites, and we send experts who will analyze and evaluate the assets. They will not only make a valuation at current, but also a prospective valuation in 2, 3, 4, 5 years, meaning all along the life of the transactions that we sign with them.
Greg, you raised, and for yourself and Jean-Baptiste, you raised an interesting word there, liquidity. So I think that's one of the unique characteristics of this asset class I think we need to unpack and explain very briefly for our participants. And because it does have a slightly different, and there's a reason for it, and we've sort of unpacked the nature of the instruments being time-based and contract-based debt instruments. But this is not a daily liquid. You know, if you're an investor in this portfolio, that's the one, not a negative, but the one characteristic in the sense of there's an element of illiquidity to the funding by virtue of the nature of the contracting in the back end. But what's the reality around the liquidity profile for an investor in these type of markets? What can they expect?
Yes, Paul. So you're quite correct. The one characteristic that is synonymous with private credit is generally a lack of liquidity or less liquidity than other market-listed investments. And it is a reality. When you go into a private credit portfolio, you really are looking for a long-term investment. But to be honest, that is why we can charge premium interest rates and get a higher yield is because of the liquidity premium that we demand. The reality in a well-diversified fund, such as ours, and as funds get bigger, is that you create your own liquidity in the fund. So as the loans pay off in an amortization profile and as you get new money in and new transactions, there's always an element of liquidity that is created. So through the products that we make available for investors to go into the portfolios, we do create a certain amount of liquidity, but in general, you're spot on. It's a longer term investment.
And Jean-Baptiste, just maybe to mention now, this is a very friendly conversation now. On the 8th of November, it's a little less friendly when the Springboks take on France. Just for one day, we're going to be slightly differing in our opinions, but thereafter, we're totally aligned.
Yeah, but we will attend the game together. So in the end, we'll have a beer or a glass of wine together.
That's
anyways.
Exactly it. Absolutely.
And, yeah,
JB, we tongue in cheek mentioned and Greg quite rightly mentioned when our clients and investors can come and visit the assets in country. I think that's an important point to make around maybe the philosophy, the Fedgroup philosophy, is that initially, before we embarked on this partnership and this portfolio that we will talk about just generally in a moment, is that you and team went on site and assessed the initial transactions now. So it was on the ground stuff, also from an overlay, and it wasn't just a total reliance. It was, we went and initially screened transactions, both from a credit standing perspective as well from a physical observation. It was a senior team of yours that went across now. So I think that's an important, there's a huge amount of due diligence that's gone into this now, and that's why we really do believe it's going to be a huge success. So before I want to get into just talking a little bit about how we've made it accessible, because we've spoken about the profile of private credit, what it's about, what it offers an investor, the duration, the risk profile, etc. I want to talk about how we've made it accessible, and again from a podcast perspective now, the teeniest weeniest side of the podcast, we will then talk where there are relevant offerings in the market now with Fedgroup and others around how these unique asset classes can be accessed. So we'll take a little bit of a liberty here and talk a bit about our portfolio. But I just want to summarize, if that's okay, if we can sort of get the three of us on the same page. What is this offering clients? What does a client get from considering private credits in their portfolio? So sort of one, we're talking now from a global perspective, you're getting hard currency returns.
Yeah.
So you're getting a hedge, you're getting a hard currency portfolio diversification. The second is, by nature of the assets we're talking about now, and we've gone quite deeply into some of the asset examples now, you're getting a stable asset return. This is not a big swing and roundabout. We know NVIDIA and the likes are massive giants of the global arena now, but I don't think they're going to be well known when we look back in time with regard to the stability of their returns. Simple as that, from a Bitcoin perspective. The important thing as well is it lives in the real world. Where we're certainly focusing, we believe most of private credit is focusing is in the real economy, the SME economy, the critical industries that make the world go round, that oil the world's industry now. So that's, again, another one from a long-term resilience perspective now. What's the longevity of the return profile of these assets? And then importantly, and this is where I put my wealth management, sort of asset management hat on, it's not everything to everyone. This is meant to fit into one's portfolio as an allocation to provide diversification and smoothing return and more return robustness in the portfolio. It's not around all or nothing. It's around a component of one's portfolio that brings about a very different return profile now. So from an accessibility perspective now, one of the sort of historical impediments to the private credit market was just littered with very high minimum entry levels. So if you didn't have institutional level type of money now, you just couldn't get exposure to this now. And I think over time that's come down. It's still a little bit complicated in many ways, but I think that's what we've tried to achieve now in launching our enhanced global private credit portfolio, is to, and importantly, that is we've in pursuing this portfolio and wrapping this portfolio in our life license and allowing a client to use their rands to gain access to this incredible asset class now, we've tried to democratize it. We tried to create a very, very low entry point now, a tax-efficient entry point now, a well-understood one, importantly for financial advisors on the podcast now, a product wrap that well, you understand, it's got all the wonderful ingredients now, but the asset sitting behind it is something very exciting and global, obviously with regard to the hedged returns. But importantly to note as well is that depending on the client and their capacity to allocate to this now, there are alternative options as well, which we can obviously always help guide a customer through, as to non-insurance wrapped access points now directly into the market, offshore, etc., which we are here to advise. I mean, you and the team, ourselves at Fedgroup Financial Services now, we can advise and help customers and advisors now to smooth the access points into these private debt portfolios. So, and importantly to note now, if anyone is interested and you would like to know more about the accessibility and how you can access these private credit markets, now please reach out to your broker consultants at Fedgroup, and they're more than equipped and willing to navigate you through that exciting process. So Jean-Baptiste, we touched on the fact that there are massive similarities between Chetwode and Fedgroup in our fixation around deep asset specialization and real asset markets now. But what for you has been the attraction factor to work with Fedgroup?
What we like in working with Fedgroup is the general flexibility in the approach. That is very important in our world, because you need to custom deals and to have them really prepared for the customers of ours, which are the borrowers, the corporates. And this is something that we can always discuss at length with Greg and his team. And it helps a lot in considering transactions, a number of transactions. It helps also in the relationship with the customers, our customers, again, the borrowers. And also, what is important for us is that Fedgroup has large ambitions in our European market, and this is something that we need. We need a partner that is ambitious and that wants to really put more than 1 foot, but probably 2 feet on the ground.
Thank you, Greg and JB. I mean, your insights are sort of invaluable. So now I'd like to move on to the exciting section of Q&A. And before we do that, just a reminder to look out for episode 3, which is already in production and already in planning phase now, early in 2026. And we look forward to bringing you another exciting episode. So let's get into a bit of Q&A. So the question I wanted to ask before I get into a question from Sanette is, we're talking about global private credit. So we're talking about offshore, international strategy. Why is an international strategy important in one's portfolio and consideration?
So one of the very important components of proper portfolio management and estate planning, as you would know, Paul, is diversification and access to an investment, a collection of investments that is broader than what you have here. So South Africa only makes up less than 1% of the global equity market, and our bond market is insubstantial compared to the global market. Our GDP is 300 million, and that compares to $300 billion, and that compares to 3.4 for France, 2.3 for Italy, etc. So you can see that as a contributor to global GDP, we're quite small, and we're very concentrated in the mining and banking sector. Really, that's our big market play. So diversification, both from an industry sector point of view, diversification from a diversifying to hard currency, because we know how volatile our currency can be. And of course, private credit itself is one of the best diversifiers in a broader market portfolio. It has got the lowest correlation to market listed market investments, and it's I think, as we mentioned before, it offers a stable return. So personally, I feel that it is an important component of a diversified portfolio, and offshore in Europe just gives you so much more to play with.
Great. Okay. Well, that makes sense, Greg. And so Sanette, thank you, Sanette de Kock. Thank you for the question. Sanette writes to us and says, what is your view on private credit as an asset class to align with an overall investment strategy and risk tolerance in a client's portfolio? And Greg, we've spoken much about this internally around sort of where the asset class sits on the risk curve, et cetera, et cetera. What's your feeling around that? I mean, where it fits into the portfolio? I mean, it's unique, so it certainly doesn't duplicate. This is something, that's, I think the point, the one thing is around, this is not something you can find and replicate elsewhere. This is a unique asset composition.
Itself.
Yeah.
And more so, it will become a household name. Private equity has almost become a household name in investment terms these days. So in private credit, you'll see in a couple of years' time, it will be a core component of any diversified portfolio. I think, as I mentioned before, it is the lowest correlation to listed equity markets. So it is a very good diversifier from a correlation point of view. And the stability just gives, especially in your income products, it just gives you that certainty that a lot of investors are looking at. In terms of if you were to plot it on your risk curve, your risk return curve, I forget what that's called, the capital asset pricing risk curve, you probably find that it sits in between bonds. So it would be money market bonds, private credit, asset-backed private credit, equity, and then maybe unsecured private credit, private equity right up at the top, and derivatives. So it fits in quite nicely in your risk return profile.
Yeah. And obviously you speak about uncorrelated returns. So these are typically, and that's the aim of risk mitigation one's portfolio, is to have the assets and asset classes that react differently at different times in the market. And what we can expect from the private credit market is that sort of decorrelation or inverse correlation to your typical listed assets that we have in the market now. Okay, so Sanet, I hope that answered that question regarding it. We don't have any other questions, so I mean, I'm hoping that is a good indication of the fact that the podcast was thorough. Obviously, you'll be able to watch it again, and no one looks like they put up their hand. So as I said in the beginning, you guys are busy people. Maybe a good time to reach out to your broker consultant and chat more about the enhanced global private credit portfolio and how you can get access to that through the Fedgroup Endowment wrap. And we're very proud to bring that to you as an access point to this incredibly wonderful asset class as we presented today. So at this point in the conversation now, I want to just really thank you for your time this morning now. Thank you for joining session 2. We look forward to welcoming you to the 3rd installment of Offshore Off Script, and we wish you a very, very wonderful week further. Thanks and have a good one.